Today, our topic is a phenomenal tool called a SAFE. This is the greatest tool that we have found for raising money for businesses where it's hard to create a value on them because you're so young. It's designed to raise capital for young or startup businesses that don't have a history or a track record to do a proper valuation. I'm going to go through this with you step by step and show you exactly what it is and how it works. It's also a great tool, as you'll see, for actually paying for companies that you acquire without having to come up with cash up front. SAFE stands for Simple Agreement for Future Equity. All right. I'm going to give you a hard case example. We're using this tool now to finance a company called Billionaire Lifestyles. It's a company that's involved in strategic aggregation. And the thing that it's aggregating is all of the various service businesses that cater to ultra high net worth individuals and their families. And so the ones that logically come to mind are companies that either sell or charter or lease or rent homes, mansions, Rolls Royces, Bentleys, all kinds of exotic cars, jets, helicopters, yachts. In other words, just think about all the things that wealthy people spend their money on. The list is a lot larger than this. The companies that will be aggregating also include real estate brokers. They include people who rent or lease a private island or sell private islands. It has to do with companies that supply security, both cyber and bodyguards and facilities security. It goes on into the people who handle the money for investment for these people. It covers anything and everything that ultra high net worth people would spend their money on. And the companies that we're aggregating are the top of the line, high level companies, the best of them that are servicing these high net worth individuals. Right now, we're very active in acquiring jet charter companies. And you're going to see that when I go into the illustration here in a little while. But when you bring all these companies together and you put them into a common ecosystem, and then you bring to it a service that we have called Scale. It's a platform that enables all of these companies to cross market with each other. So as we acquire these companies that do these things, that service these high net worth individuals, we are able to then cross market their clients and make the clients of each of them the clients of all of them. And it's a very sophisticated process that we use to do that. It's all automated through Scale, which is a platform that handles all of this. It automates the whole process. I won't get into it in any detail today because that's not my goal. My goal today is to share with you this tool called the SAFE, this method of raising money, what this agreement is, what it does, how to use it. And I want you to see by a hard example how we're using it to fund startup capital for Billionaire Lifestyles that pays for the operations while we're getting all these companies organized, and then also helps us to pay for the acquisitions in two ways. One is to raise money for the cash portion of the acquisition, and the other is to pay the seller in part with future equity that will be very valuable to them, more valuable than the original money they got for their company. And you'll see how it's an exciting tool to use. So now let me give you an example of what I'm going to show you. And I'm going to give you the result, the bottom line first. And then what I'm going to do is to work from the very beginning then, and then take you up to what it is that produces this result. What we're going to do here is we're going to take 12 companies for our pro forma that in 6 years would be worth collectively on their own. And these numbers, by the way, here are in thousands. So this is $401,383. So the companies we're acquiring, 12 of them, if we just left them alone on their own, just their own pro forma projections, and then did a valuation on them based on their projections for what they're going to do into the future, these companies would be worth approximately $401,383,000. Okay, so that's this, and they would be non-liquid because none of these 12 companies would have an ability to go public on their own. Okay, so this is what they would be worth as private companies. Then we're going to combine them in an ecosystem, as I've been explaining. We're going to roll up their competitors into their companies. We're going to buy their competition and then roll them up into their individual companies. Remember, we own the companies now. So now we're taking the companies that we just bought into this ecosystem, and then we're going out and buying up all their competitors. And you're going to see where all the money comes from to do this. It's an incredible tool you're going to see here. Okay, we're going to deploy the scale platform, strategic aggregation platform, which is now going to cross-market the clientele of all of these companies one to the other. Okay, and then that will develop companies with a market cap, a total valuation of $17,928,718,000. Okay. Now, the way that this works is, just so I can carry you to where we're at, we're going to create leverage on leverage on leverage. And that's how you do it. In business is all about leverage. How you leverage one thing to more things, to many more things, to phenomenally more things. All right. And so what we're going to be doing is when we take these businesses that alone are worth 401 million, but then what we're going to do is we're going to combine them together, cross-market their database, buy up their competition. Each one of these is a leverage point. Deploy the scale platform, and then IPO, which takes businesses that are worth 5 or 6 times earnings to businesses that are worth 14 or more times earnings. And so when we do that, we end up with leverage on top of leverage on top of leverage. And you're going to see in the pro forma exactly how this works out. You got a company that's now worth almost 18 billion as a public company. And what this does, if you look at the numbers, multiples on multiples, we're taking companies that would have been worth 401 million, and we're making them worth 45 times more than they would have been worth alone. So by this process, they become worth almost 18 billion. The companies and their owners who are actively participating in this process will be creating over $17 billion of new wealth. If this becomes this, okay, we've literally created $17 billion of new wealth. And the amount which has been earned by our platform partners, the people whose companies we bought, these 12 companies, is now worth $2,366,960,000 to them. In other words, that's the total amount that they will have been paid by the end of this process. So that at the end of 6 years, instead of being worth 401 million, these 12 company owners are taken to the bank $2,366,960,000. The amount they would have created on their own, this number here, multiplied by 5.9%. Now, what happened if we created 45 times and these people get 5.9 times? Well, that difference is almost 40 times. Who gets that, right? That difference. It's owned by public shareholders. It's owned by us. It's owned by a number of different parties who are who created the leveraging process and exploited the leveraging process to make that all happen. But all of our acquired companies, those sellers got 6 times what they would have had they not done this aggregation with us. Okay. And some of our platform partners will substantially increase their results by a stock swap instead of composite upfront cash of 106 million. Because what we did here is we bought these companies, not in year 6, year 1, and we paid them $106 million for their company. And then and we left them owning 25% of their company. But if they did a stock swap of their 25% of their company with us for shares in Billionaire Lifestyles, then we would have increased their value by that amount of money. Okay. So by a lot more money that they would be worth. You'll see how that all works out. All right. Before I move on, I just want to have you get this picture. Okay. So what I'm going to show you now is how $401 million standalone companies, when we put them together in this format, it's going to equal 17.9 billion. Okay. And how are we going to pay for these acquisitions? Okay. So let's take a first look at our model of what it is that produced all this here. What we did is we took what we called without acquisition, acting alone. Remember that number I gave you for acting alone, 401 million? All right. This is their revenue projected into the first year that we own them. This is their revenue projected into the second year, third year, fourth year, fifth year, sixth year. And these projections came out of a very serious discussion with the 12 acquisitions that we're looking to make. So these companies that were producing this amount of revenue would have this amount of EBITDA. So 24.9 million all the way up to by their 6th year, they would be earning 75 million. All right. And their valuation, their valuation would be these numbers here. So these companies producing these profits based on a 5 times multiple of their earnings, this is essentially what it is that they would be worth as a private company. Now, we don't show anything here as a public company because none of them would have the ability on their own to go public. That's another layer of leverage. We're going to add that in a moment because even though the companies are worth this, doesn't mean they can sell them for that. Somebody's still got to write them a check and they still got to go out with a long process to find those buyers. All right, let's take a look at the next level of leverage up. Okay, so we're going to add the acquisition, the roll up under each of our 12 verticals. This would be the EBITDA. Okay, this would be the valuation private. But now, because we've rolled up all of this to all of the 12 vertical companies and all of their, or not all of their, but a substantial portion of their competition, we now have a company that can go public. It will qualify for a high growth public company. And so now we start to look at going public anytime between the 3rd year and the 6th year. And if we went public in any of these years, this is what the company would be worth on a 14 times multiple of earnings. So here we projected 5 times. And that's what this is. The valuation private is based on 5 times earnings. The valuation public is based on 14 times earnings. So if this is our unit up here of what everybody would be worth if they were alone, that's 1. If we put them together and roll up their competition, these folks now become 7.2 times as much because we rolled up their competition. And what is interesting to note here is that the rolling up competition produces substantially more income than these guys ever would have made on their own. Why? Because every year we're rolling up 1 or 2 the first year, 2 or 3 the second year, 3 or 4 the 3rd year, 4 or 5 the 5th year. So ultimately, the dynamics of roll up produces a way bigger company than the original company that we bought, in which we made a platform for the roll up of all those companies underneath them. Because what did we buy them? We buy them because they had great management. They knew how to grow their company. They had a proven track record. They were making money hand over fist. And we just showed them a better business model. They rolled into our better business model. They became the platform company. And underneath them, we bought up all, or I say all, because there's some industry we may buy all of them, but many will buy a substantial portion of their competition. And so that's the second area of leverage, leveraging the platform company that was a great company into now having control. Now, the next area of leverage is we now take these companies and we start to cross market them. So here we have revenue again of what's created by scale. Once this is enhanced, this is unenhanced. So these are the same companies, but now we enhance with cross marketing through the cross marketing automation platform. Okay. So now these are additional earnings. And so now what's happening, since here we can go public and here we can go public, we've brought a company that would have been worth these amounts of money here in these various years to these amounts of money here in these various years. Now you'll notice there is a significant increase year to year, but it's not earth shattering. It's not earth shattering. Okay. It's great. And if you can do it, you would certainly do it. But I wanted to show you the difference between just taking 4 verticals in cross marketing versus 12 verticals and cross marketing. So here we've already brought a unit, these companies here, to where this base is now worth 7.2 times. And once you add the cross marketing, they're worth 10.3 times. And if you're taking it public, it's worth 22 times. Okay. So now we made one worth 22 times the amount by the way in which we layer leverage on top of leverage on top of leverage, public versus private, cross marketing, all of that. And then the last one here that I'm going to show you is what happens when you have 12 verticals. Okay. And what happens to the added revenue now, the difference between these two added here. So now with 12 verticals, what was an $8 billion or $8.8 billion valuation public here becomes a 17.9 valuation public here, or 44.7 times this. And you'll remember hopefully this number of 17.9 billion here, because that was the number I showed you on that prior slide that I went through with you. And this is now how we got there. This is the skeleton, the bones of how we got there. Okay. So this is what produced the 17.928, this 45 times, and this is just rounded off. If you don't round it off, it's 44.7 times. All right. So now I've stepped back into the actual composite of everything that we did to get here. And what I'm going to do now is take you one step down even below this and show you a little bit more of how it is that we got here. Basically, what we did is we built out, and we do this on all of our strategies and structures. We build out a very comprehensive pro forma model. And what it enables us to do is to take all of these various entities and do a pro forma on each and every company and then composite them together. And when we're all done with it, everything comes together and we're able to make changes in real time to see if we change in any way the multiples, the formulas, if we're adjusting the strategy, we can know in real time how that's going to affect us over this 3 to 6 year projection process and how we're going to get there. Basically, what we have here, simply enough, is this takes a platform company. This company had 130 million in sales. Okay. It had 12 million of EBITDA. It's a jet charter, what we call a fulfillment engine. Okay. And what that means simply is that this jet charter company operates its own aircraft. Okay. As opposed to a brokerage jet charter company, which is just sells other people's time on other people's aircraft. This company will either own its own aircraft or it will manage aircraft for people who own their aircraft and handle them through that charter process. And they handle everything that it takes for that company to do it. They're certified by the government to fly these planes and to be that charter facility that owns and operates the aircraft. So in any event, this company had and this is real, by the way, these are real numbers for us. It's 130 million in sales. They do 12 million in EBITDA, and their valuation private is about 60 million. In other words, 5 times EBITDA. Based on their pro forma projections, this is what their revenue was projected out at. This is what their EBITDA was projected out at. This is what their valuation private would be based on those numbers. And if you'll recall, we did this in that composite that I showed you before. We composite different verticals or 12 different platform companies, of which this was one. So what you saw before was all of our verticals added composite together. Okay. Now I'm going through one different individual one with you. There's a public compliance cost for these companies that we have to deduct here in terms of what we're going to do with them. There's the public EBITDA of this. Okay. So if we're going to take them public, okay, and we need to combine the valuation public, we have a compliance cost that part of them is going to be allocated to them, but their portion of it. So that gets deducted from, in effect, their EBITDA is now going to be a little bit less than it was if they stayed non-public. But now this becomes the valuation public because this EBITDA is worth 14 times, whereas this EBITDA is only worth 5 times as a private company. So hopefully that makes sense to you and you got where these valuations come from. So these are the numbers that came into that other illustration that I gave you. But then we had other companies that were also composited in there that gave you those numbers for our overall company. Back to this individual company again. So now their external acquisition growth, this is what we projected for rolling up their different competitors. We looked at all the different competitors, their size. We did a very thorough study of the market. We have a really good understanding of the level of companies and their size and all of what's going to be true for those companies. And this would be their estimated EBITDA. Then the valuation added private was this amount of money. But then if we could take it public, we got to cover that compliance cost of actually doing the public offering. And this would be the new EBITDA, and this would be the added valuation for taking that company public with this is what the roll-ups would add. Okay, then this is the total valuation private of this. The value added public is this. The total value public is these numbers here. But then what we did is we carried it even further so we could show it to the sellers because they want to know what they're going to get out of it. And so we continue the pro forma here, and this is what we would be paying for the company. This is to the sellers. So this is basically what they would be getting out of it. And this is what the buying company ends up getting out of it. That's us. Okay. The equity valuation share public. This is what the sellers would be getting out of that company. So this company would be bringing the sellers almost $1 billion in money that they get from our transaction that they would have only had 200 million worth here. They end up with almost $1 billion here. On the other hand, from doing this, us and our investors have made 2.998 billion, almost 3 billion. Okay. This is the way this basically breaks down. All right. This is a composite now of just this one company. Okay. And what our pro forma is showing. And then we go through here and we actually give you the inputs that enabled us to get this. I wanted to show you how sophisticated our model is, because in order to get this, we had to create inputs that then had certain mathematical algorithms applied to result in the numbers that you saw. So this is where all the inputs were put into the system. So the 12 trailing months revenue, we put in 130 million. The EBITDA was 12 million. The revenue growth rate, this has been their growth rate for the last 4 or 5 years, 20% per year. So we projected that out into the future. This has been their EBITDA margins historically is roughly 9.2% on sales. But once we start doing certain things with them, we know that those margins will be increasing because of the leverage points we're going to make. This is the valuation we use for the value as a private company, multiples of EBITDA. This is the multiples of EBITDA we used as a public company. Then this model is based on us buying 75% of the company, giving them cash for that, and then 25% of the company they continue to own, and they roll that into the public company when it goes public. Okay. And so these are our different scenarios that can happen: full stock swap, partial stock swap. This is if they stay in and swap stock for Billionaire's Lifestyle instead of keeping the money in their own company and then selling it at the end once we go public, or selling that balance in. Okay. This is our projection for the roll-ups. Companies are around 35% of the size of the original company that we bought, the platform company, the one that was base company that then did the roll-ups. So these roll-ups are around 35% of that size. We did 2 the first year, 4 the second year, 6 the third year, 7 the fourth year, 8 the fifth year, and 9 acquisitions in the 6th year. Very doable. We do this on a regular basis here at National Diversified. So we know what these futures are. Then the cash flow distributed to owners is 80% of the cash flow. So all along the way, all of this additional money we're going to be creating, the sellers are going to get their share of it in the 25% that they own. And we're going to deliver out 80% of our cash flow to us and 80% of our cash flow for the portion that's owned by the sellers that they retain. That's that. Okay. Now the next thing that's going to happen is there's going to be a buyer co syndication. In other words, buyer co is a code word for the platform company. So this just gives us what the parameters are for the people who invest in the parent companies as in the platform companies, as we do the roll-ups. And these are earnings that we actually get because we syndicate the investors who now make the investment that enables us to do all of these acquisitions. And then these are hard assets that are owned by the platform company that we're acquiring. These are jets that they actually own. They actually have 3 now. So this is going to be changed in the model that we're currently working on, because they now have 3 jets that they own and 15 jets that they manage, but they don't own those jets. So they're not part of the assets that we're buying. We're buying the management contracts for those jets in that company, but not the hard assets. Then we go through the source of funds. Okay. How much money is it going to take to buy this company? Okay. And how are we going to get that money? So we start with the use of funds. What do we need money for? Purchase price payable to the seller. We're going to need 45 million in cash, working capital for the buyer co. That's their company that we bought. So we can have working capital additional $1 million, contingency and a reserve for various debt payments, working capital for the platform company, another 1,950,000. At 950,000 growth capital, due diligence costs, roughly 100,000, accounting 65,000. These are the various costs. So we know we're going to need $52,991,000 to buy this company. That's the amount of actual cash that we need. And over here, these are all done by formulas, because once we know this, because of these various things that are true for charges and things that we have to pay for here, that this is the amount of money that we actually have to raise in order to pay the points and the charges to have the 52,091,000 left over. And then these are just the factors that we have to deal with. This is how much is going to come from bank loans, 7.8 million. This is how much is going to come from mezzanine financing, net 32,470,000. And the equity investors who are putting up the money, these are the people here that we are going to give safe agreements to, as you will see when we do this. Okay. This is where all of that comes together. So how much you have to raise, because this is how much money you need to spend. Okay. Then the syndication investors, this is what they're going to earn. I'm probably getting into way too much detail right now, because what I want to do is just show you the sophistication of our model so that we leave nothing to chance. No stone is unturned. Every element is considered. They're all tied together through an Excel master spreadsheet with the algorithms that tell us exactly what happens in each of these things as one interacts and is applied to the other. And then we even take it down to the public offering, what's going to be true of that, how much IPO company market cap is going to be basically in any one of these years, how much of the company will be sold in the IPO. We'll be selling 15% of it. That's going to raise cash. This is the amount of cash it raises. These are our costs. These are all the fractions or percentages of the amount raised, even though these are fixed costs, many of them. They usually fall into a certain percentage range. These are the actual costs, total underwriting and compliance costs, net cash to the company, and even a percentage of the owner's stock. So in other words, our stock, all of these people whose companies we bought who now have stock in the public company, 20% of that total amount of shares will get sold, but now not from the company, but from the owners of the stock. So that gets piggybacked into the offering. And so this tells us the amount of money that goes net to the buyer co, which is our company that gets money from this, and net to the sellers themselves out of this. So this basically just tells us everything we need to know about the public offering. And these can all be changed. Anything in blue can be changed based on you find out something is shifted or it now needs to be recalculated slightly differently. Those numbers are like pivot points. They can all be changed. And that change then ripples through the whole pro forma to give us now the accurate numbers. Those things now being true, what would that actually produce? Hopefully that all makes sense to you, but I wanted to give you the big picture so that, we don't just pull these numbers out of the sky. It's a very sophisticated process, a lot of research, a lot of mathematical formulations that govern how these things are calculated. And it all gets done in a way that we know pretty much where we stand. Okay. Now let's get into the SAFE model. Okay. And what that is and how it raises money. These numbers up here you saw before. Okay. These come right off of our pro forma projections. And I always come back and point to this one number here that I know you'll remember. It's the $17.9 billion valuation as a Billionaire Lifestyles valuation as a public company. Okay. And here's how a SAFE works. What a SAFE is, it's an agreement for future equity, and it's at a discount. Now, the hardest thing to understand about the way that they calculate this is something they call the discount rate. Okay. So here we're offering a discount rate of 73% in the first year if we have a public offering or a funding in the first year. And let me back up a second. Why does this thing funding matter? Today, if I were to try and value Billionaire Lifestyles, it's impossible. The company is a startup, basically. It has no income yet, has no assets yet. It has a business plan, a great management team, a great concept, and we've got a tremendous amount of intellectual property behind it. And we've got acquisitions that we're in the process of making. We've got agreements in place. We've got all that stuff. But to put a value on the company is almost impossible. So we don't try to sell people or engage people with our current valuation. We say, we're going to give you instead a simple agreement for future equity. So what you're going to do is you're going to give us $1 million right now. Our agreement says is that we do a funding or anything where the company is valued, where we've now gone through a appraisal, true valuation mechanism. Then on whatever that shows, when we do that funding, whatever we are in effect selling stock for at that time, because we've done the evaluation and the company now has enough resources and momentum and income to be valued. And whatever we sell the shares for then, you get, and this number gets confusing because what it says is the way that the math works, the discount rate is exactly the opposite of what you'd think it would be. What this is saying is the difference between 100% and 73% is 27%. So this says we're selling the stock at a 20% discount. So if people here pay $10 a share, we'll give you enough shares at, instead of $10, we'll give you enough shares at $7.30, okay, that make up your $1,000,000. So you get more shares than the folks who put up the money at that time. Your discount is 26%, or you pay 73% of what it was, but you've already paid us the $1,000,000. So you get enough shares to equal the $1,000,000 plus the discount. Okay. So you're going to get, instead of 100,000 shares, if it's worth $10 at that time, you get $1,369,000 worth of stock because you're getting it at a discount for your $1,000,000. If we did it in the second year, we would give you a 67% discount rate, which means that your $1,000,000 now would have bought you $1,481,000 worth of stock if the valuation was done at that year, and so forth year by year. And if we're public, then it's the public offering that determines all this. Since we plan to go public around no earlier than the third year, and more than likely around the fourth or fifth year, these are the more likely discounts. And if we wait all the way to the sixth year to do it, then they would be getting it at these discount rates. So it means they would be getting, for their $1,000,000 here, they would be getting $2.5 million worth of shares. For their $1,000,000 here, if we went public in the fifth year, at that time, they're getting $4 million worth of shares. And if they did it in the sixth year, they're getting $6,666,000 worth of shares. And if you look at that, their ROI on their investment that they made here when we couldn't value the stock, because at some point we'll be able to value it. By the sixth year, their ROI is 5.7 times. In other words, they got their million back. If they sell it out at that time, they got their million back plus 5,666,667 worth of profit. Their compound annual growth rate was 37.2%. Okay, so that's the power of this particular agreement, is it enables us to pay for this $1,000,000 here, not with equity in the company now, because we don't know what it's worth. But when we know what it's worth, we pay that $1,000,000 by giving them much more value in stock at that time based on these discount rates. So just so everybody understands, and I'm going to hit you with this a couple of times to make sure you're connecting with it. If it says 40% discount rate, it means you're buying the stock at a 40% discount or 60% of its selling price. Okay, here you're buying it at a 15% discount rate. So here you're buying the stock, you're getting $6.6 million worth of stock because your price for the stock that you paid $1,000,000 for is determined now here. And so now, because of these discounts, you're getting $6,600,000 for the $1,000,000 you invested here worth of stock as it's valued at that time. Very powerful concept, because now we don't have to create a valuation here. All right. Now, this is what actually would happen to the shares as we go forward. So assume shares of BLS outstanding. The first year, maybe we had 10 million shares out. But now we've made acquisitions, we've used stock for acquisitions, we've given out other agreements for equity and investment. So we're always adding more shares. And let's say by the end of the sixth year, we have 135 million shares outstanding. And then the value per share, if these are the values up here, if this is what it's valued at, then these are the values per share. This is the discount per share of private. Okay, so this is how much we're discounting them. The value per share if private, discount value, discount price per share. This is what they're paying for it. So if the company is value per share is these, then the values that they're paying for that we're using their $1,000,000 to buy stock, instead of buying the stock as if it's $29, which is what it's worth at these times, they're buying it at these prices instead. Okay. Value per share of financing if public. Okay. Then this is the amount they're getting it for based on the fact that they've paid us the $1,000,000, but their stock that this $1,000,000 is now buying is based on these prices here. So they're getting a lot more stock. So shares to the investor if private, if we go public, if they're doing it the first year, this is what it would be. Second year, this is what it would be. Third year, this is what it would be, and so forth for each of those various years. And that's how we get these numbers here that correlate to the numbers that up here. Okay. So if we do the ROI in the third year, their ROI is 2.6 times for private, 7.3 times for public. If they do it in the fourth year, it's 3.1 times ROI, 8.7 if it's public. These are their compound annual growth rates and so forth for each of these various years. So the longer it takes us to go public, the longer we're holding their $1 million without giving them shares for it. And they've had their money tied up for a longer period of time, which is why we schedule it to give them bigger discounts so that every year it takes us to go public, yes, we're holding their money, but they're making more money, a lot more money when it happens because of the increasing value of the company and the discount rate being progressive the way we set it up. Now, when we get to the Q&A time, I will try and answer any questions that any of you may have on this. So hopefully that'll take care of us then. All right. So raising capital with a safe, simple agreement for future equity. Let's take a look at actually how it works and how we set it up. Okay. So the first thing we did is we had the $1 million. I just went over that with you. So you see how these numbers came out. Okay. And then we also enable people to have a more favorable discount rate if they use a larger safe. In other words, a safe for a larger amount. Whereas before we had the $1 million investment with an ROI of 5.7 times on a public company by the 6 year. This is all based on the 6 year. Okay. It was $1 million. That $1 million bought them $6,667,000 worth of stock in the 6 year. If they invested $2 million, then the discount rates are different. You'll notice that the first year they're the same, the second year they're a little different, and then each year they're a little different. So instead of 50%, it's 52. Instead of 40, it's 37. Instead of 25, it's 22. Instead of 15, it's 12.5. But the difference is that their amount of money is going up by more than double, as you will see. Okay, so they're getting a better deal. They are getting a ROI of 7 times instead of 5.7, a compound annual growth rate on their money of 41.4, and their valuation at the 6 year is 16 million, which is more than 2 times, obviously, the 6 million six. So that's the advantage of going to the $2 million. If they'll go to a $3 million investment, we increase these discount rates even more. And so they're able to have 3 million literally produce 30 million by the end of the 6 year. If they do a $4 million investment, discount rates still get to be dropped even further. So now they've got an 11 times ROI, 52.3% year over year compound annual growth. And so their valuation of that same investment by the end of the 6 year is 50 million. And we keep doing the same thing if they buy 5, if they buy 750, and if they buy 10. So on a $10 million investment, they'd be getting a 14.4 ROI, a 57.7 compound annual growth rate. Their 10 million would be worth $153,846,154 in shares in the company at the 6 year. Okay. It is the value of their shares in the end of the 6 year for the $10 million investment. So you can see how much more powerful we've made it to induce people to want to have higher investment level, because we have to do a lot fewer of these to raise our money than we do of these. So this is based on the fact that we really need 10 million. And we said, look, if we have one investor and they'll come in and do the whole thing, we'll make it so profitable for them, they can't say no if they've got 10 million bucks to do this. And then in the lesser amounts, we have to now go out and find all these investors, a lot more work, a lot more time, a lot more risk on our part of having to go out and find them all. So we've given more and more discount rate to higher numbers. Okay. So you get a sense of what that does to all of this. Okay. Now, before I go any further, I want to also tell you that there's one more thing that we're doing, because we're in the process of raising this money right now. So we know of most of the folks that are on our call today aren't sitting around with millions of dollars in cash and capital. But we felt that if any of you, our members, our Bizar financing members, wanted to invest in one of these, that we would set it up so that they would have a minimum of 100,000. We would keep all the numbers the same as for the non-members, that you have to invest $1 million to do. So the 100,000 would produce literally 1/10 of this, because it's 1/10 the investment. but still would give each investor approximately 6.6 times their money. Here, the reason it's a 5.7 here is that's the return on the investment, but you also get back your investment, which is how it becomes 6.7 times here. Okay. Let me give you this URL here. This is the URL of the company that invented this safe, and they support the marketplace with the most updated versions of a safe, and they have all the templates for them. Copy this down. Okay. It takes you to this website right here. And on here, you can click in on these various safe agreements. And then they also have on this website a lot of explanation of the safe, how it works, why their various provisions are in their documents, so that you see through a lot of transparency how all this was actually put together by the folks who invented. This was invented, frankly, by the folks in Silicon Valley who were having to finance or buy startup companies, private equity companies. So the private equity company is going to invest money in the company. They're going to bring in outside investors, and yet the company has no way to really value it. So this concept was developed by the Silicon Valley folks, the high-tech folks, to enable people to have an assured outcome for their investment, as opposed to a truly speculative investment where the number of shares they get or the percentage that they get may not mean anything in terms of what the company is going to be worth.